Good morning, everybody. Welcome to the Flow Show. An explosive start to the week we've seen from what's gone on in Europe this morning. So that's given us some extra fuel to the fire as we run into US CPI and Fed week as well. Morning, Kay. How's it going?
Good morning, Ryan. Morning, everybody. Yeah, it's going well, mate. Thank you. I hope everybody's having a good Monday morning after an excellent weekend. Here we go again.
Yep, light the fuse and we go again. Right, let's see what's going on. We'll start over in Japan. Further sources, pieces from Japanese press saying that the Bank of Japan are going to weigh the future of their bond purchases at this June policy meeting that we're getting on Friday. So that's going to be the hot topic. I think very little chance of seeing any rate moves, a rate hike, and the discussions really around what they do with bond purchasing, which shouldn't be too inflammatory for the yen, unless it's a real big amount that they decide to cut. If they decide to cut their purchases, that might be a big, huge hawkish signal if they go more than what the market's expecting. But otherwise, a bit like QT in the rest of the central banks and the like, it's happening. It's going to happen. We're just trading when it's going to happen and how much it's going to happen by. But that's probably the only risk for Friday. There wasn't much good news on the economic front. We got the final GDP numbers for Q1. We're obviously already into well into Q2. The year-on-year number improved a bit. It only came in minus 1.8% year-on-year. The quarter-on-quarter number coming in minus 0.5 as per the flash reading. CapEx wasn't as bad as it was first came out, down 0.4%. Expected to come out down 0.8%. And that GDP price index 3.4%. So lower than expected, 3.7%. We already know that the BOJ is looking through a lot of this data, focusing on what's to come in the new fiscal year. So not much to do about that. ECB's Kazakhs says we need to ensure inflation doesn't come back. We finished up on Friday with 14 ECB speakers, which is over half the governing council after last week's ECB meeting. I think that's possibly a record for the amount of squawkers we get after an ECB meeting. So it's over 50%, as I say, the whole governing council. ECB's Casimir summed things up this morning. He said there's no need to worry about rate moves in July, and we should not rush into another rate cut, and we should pause over the summer. So he's got his bag packed for the holidays. He doesn't want to do anything. He says September will be the pivotal month. So he's got the bucket and spade in the back of the car and he's off on his jollies. That's probably going to be the theme from a lot of ECB central bankers. They'll either be watching the football going into July, which starts on Friday, or they'll be having one eye on the beach. Last week we got, well, let's go over what happened this morning in Europe with these elections. So we had the European Parliament elections, which Kay flagged up as a potential risk last week. And what has happened is that a lot of right-wing parties have gained traction in these EU Parliament elections. Now, they've gained traction in their own countries, for example, France. So for those that don't know how this all works, you vote for MEPs in your own country, parties from your own country that go into Europe. They can be affiliated or separate to domestic parties already operating in France. These MEPs that go into Parliament in Europe, it's pretty much largely for show. These guys don't bring about policy. Like, they can't walk in and say, I want to do X, Y, Z with policy. Policy isn't decided that way in Europe. It's brought about by civil servants who form laws and policies, and then it's pushed through committees and hearings and blah, 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 blah. And then MEPs vote on that stuff when it's all been done by other people. what this has done is it's upset the apple cart in these individual countries like France, which Macron's called an election because of the success of these right-wing parties. Germany is up in arms because of the same thing there. The Belgian PM has resigned over it. So the danger isn't really to Europe and European Parliament. The danger is to each country. For example, France. What Macron has basically done is called an election to call out all these people who have voted for these right-wing parties' MEPs. And the reason he's done that is to say, right, well, you've basically used that as a protest vote, potentially. Now, put your money where your mouth is. Are you going to do the same in a real domestic election? So it's all a bit of horseplay at the moment. So while this is bad news for Europe, we've obviously done a negative reaction in the euro. Doesn't necessarily mean that Europe is collapsing into a fiery pit. It's a risk by Macron. He could see these right-wing parties gaining a larger share and putting his leadership under pressure, but he's already been losing steam over there in France. So the election is slated for the 30th of June, so we've got to keep our eyes on that and how that performs. But if you put it into price moves, yeah, the euro's been hit. Compare it to the NFP. We did 100 pips on the NFP, we've done 50 pips on the election. So that sort of shows you the importance. The euro and dollar pairs were always likely to be under the cosh after Friday's data coming into CPI week and Fed week. But this is just more negativity for euro dollar, hence why some of the other pairs, cable, Aussie, are holding up a bit better. So a lot of banks already out saying this is the euro going to 105 on this election risk and blah, 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 and the world's ending and all that sort of stuff. But the reality is probably far from that for now. So don't get sucked into the press narrative because it always tends to go a bit further than the reality will point to. Kay, what's your thoughts first in all this baloney this morning?
Yeah, it's how should I say? It's a bit of a confirmation of what's been happening over the past years in Europe, right? But where I diverge a bit, and then also that will have to do with the markets as well, is that it's never good though for investors or money managers when you see governments fall over such, which has been over the years a bit of a minor thing, and those European elections. But when you see governments start to fall over it, that's never a very good news. And then it also, that was a bit of a show boating as well. I don't even, was it S&P downgrading France just a notch the week before? It all comes like on the back of each other. There is, to me, and that's where I also think it may last for a bit longer, is that von der Leyen may not have it that easy anymore, because she got her mandate with only 9 or so votes difference the last time. And where it could play up a bit is that those far right political parties are not as supportive for countries like Ukraine and stuff, and they are very anti-immigration, and that may be where the impact will be coming from. We have seen like I think it's still a very subdued reaction, because the market is wondering what's going to happen next. We have, like, obviously, if you talk about solely the euro dollar, we have obviously CPI and FOMC coming up this week as well. And if you look even at the option markets, they are still not very, very nervous, barring the weak events here. You see the overnight has ticked up a bit, but okay, on the back of those results. But the weekly vol is a bit higher, but that comprises the US CPI and the FOMC. But beyond there, I mean, the option market has ticked up just a little bit. Is nowhere panic stations yet. So I think the first reaction here is a bit logic, because I think there's governments falling over it in Europe, and probably money managers will be reluctant, at least, to invest more in Europe. And actually, if you look at it, it's a bit of a naughty side effect, and I just want to check if I'm not saying anything stupid there, but I think the European yields are actually are they ticking up a little bit right now? Yeah, the bunds are lower, so the European yields are ticking up, and then that may just mean that some of the investors are actually legging out of a few European bonds. It doesn't mean anything good actually for the euro if investors get out of the bond market. So I think that may continue to happen over the next session or two, until we get into that US CPI, and then the world may change again. I agree with you. It may not have a long-lasting effect right now, because we don't know what's going to happen later. If von der Leyen gets her second mandate, no problem. If we get then later down the road an anti-far right vote again, which we have seen. We have in prior elections, was first of all it was her father, and now it's Marine Le Pen, and anything but a Le Pen in the House. So that may still then reduce all those risks. But yeah, I think a logic reaction right now, and some investors perhaps are being a bit cautious about all things euro right now, because that's what we've been banging on every time we talk about events happening. It's investors are all about certainty and uncertainty, and now we are living back again in a bit of an uncertain period.
Yeah, very much. And just to bring some context to this, the main danger for the euro is not what happens in European Parliament; it's what happens in the domestic politics. Okay, here's the breakdown of all the parties. All these right wingers gaining are all in this mob, all in the others. Okay, so some of these bigger parties have lost their share, but it's just been an increase in this little slice of the pie. So this is all encompassing in here. This is Renew Europe is the French arm, if you like, of their European MEPs. So Macron's mob. They're still the third largest party. This is the Social Democrats Party, which is obviously backed a lot by Germany. And this is the European People's Party. So these are all the centrist parties that have been, holding the majorities and whatever. So it's just these parties that have lost a bit of share. But as you can see, in terms of EU Parliament, it's only been a small slice of the pie. Domestically is a different story, where it's been a big gains in France for these right-wing parties. So you have to know the difference between what it means for the European Union and what it means for France. Macron didn't call an election because he lost a few seats in this one. He called it because these right-wing parties have gained in France under the banner of the EU parties. So that's why he's going to the election, as I say, and he's saying, right, go on then. If you want these right-wing parties in, you've got them in Europe. Let's see if you've got the balls to put them into France and into government. So that's the gamble he's calling at the moment for this one. Right, let's give it that. Moving on. If I get my bits and pieces ready. Right. So yeah, we'll go back to last week just to see what's gone on. Obviously, the big numbers out. Before that, I haven't even got it loaded on. We have Mexican CPI out before the US stuff. Numbers coming a little bit softer on the core, 4.21 versus 4.37 previously. CPI, headline CPI, 4.69 versus 4.65 previously, was expected to go up to 4.82. So that's keeps the Mexico maybe in the slightly easing mode, but they're probably sitting on their hands waiting for see what happens with the fiscal policies and other policies. As I'm talking here, we are just tapping on the door of this 1850 area, which is a big, huge area. Let's get that up there quickly. So we're knocking on the door at the moment, this 1850. This, as we've spoken about last week, these are sort of levels where if they break, we may see a bit of a capitulation coming in, where all the carry traders are now suddenly sitting up. They weren't overly worried in the first election moves, as we saw from that ratio data of MEX yen. Only dropped 1 pip of longs. The ratio of people long MEX yen only dropped a small pip, but this sort of move above these big key levels might get, as I say, cause a bit of capitulation, and then we get a speedier run up than we might have normally. So keep an eye on this level. We're trading it right at this moment. Right, over to back to the data. We'll go with the Canadian stuff first, just to get that out of the way before we go through the US stuff. That was a decent report, Kay, or decent enough. 27,000, just under 27,000. But a bit similar to the US stuff. Unemployment rate went up even while the participation rate went down. So seems to be following a similar pattern over there.
Yeah, and also the balance between part and full time wasn't great. So yeah, a bit of a lukewarm report, right? And yeah, it's a bit of a yo-yo between the part and the full timers over there. I mean, it's hard to find a real pattern in it. If you see it like 1 month up and then the next down and then in the middle, and lukewarm, I'd say. The market was probably trying to find a confirmation whether the prior one was a really was a bad one and a one-off, and now we saw a bit of a revival. But I mean, it's very average average report. We know also that immigration over there is going up. So I mean, perhaps the headline number should be higher if it reflects people getting all of them or a lot of people getting those jobs. So yeah, I think most of the heavy lifting has been done by the US dollar over there, rather than the CAD being very offered. But we have to note that the techs are looking more supportive now for the dollar Canada after a few attempts. We are now above that 137 figure 20, and then even now breaking above this 137.45.60. So that's all looking a bit more positive, right?
Yeah.
That for the jobs report. And if I just may say one thing about the Mexican, they seem to have like the superpowers in what is it, the lower house, but not yet in the Senate. But they are only missing like literally a couple of seats. So I think the market is still looking at the mix as saying like, well, they can go ahead and push with their push ahead with the reforms which they all promised. So I think that is keeping the mix under the cosh this morning again. And as you say, we are on a big level right now. So I just wanted to add that because there was a bit of news coming out of the weekend in regards to the majority that what is it, Morena, the Morena party on the Sheinbaum and AMLO in the background still have, right?
Yeah, exactly. And I'm glad I looked at that, because I've just taken a bit off my long.
Yeah, nice trade that one, mate.
Yeah, thanks, mate. And not typically not as much as I wanted on. I had the bids in at 17.43 that just missed out. But yeah, I'm happy to be in it, so I'm not going to complain on that one. And yeah, I think if this 18.50 level goes, we could be on for a flyer. But we shall see. We shall see. Right, so then moving back to the US data, and this a real difficult one. Okay, headline number, very good. Obviously blasted expectations, 272 versus 182 prior. So that was good. Wages back up 4.1%, a decent jump there. Prime month got revised up. It was expected to come in at 3.9. So that is very strong. And even on the monthly numbers, wages still strong. However, the unemployment rate which, where is it? There, jumped to 4%, and that was as the participation rate came down. So that's a double negative. Usually, if the participation rate comes down, that takes people out the jobs market, so that can cause the unemployment rate to come down. So when the unemployment rate goes up and the participation rate comes down, is a double negative. So what does it all mean? Obviously, the dollar took a flyer on that. Saw the headline, saw wages, got all hawkish about the Fed, or less dovish about the Fed. I think on balance, the Fed are more going to be looking at that unemployment rate and that participation rate. That will be a worry, the participation rate. Why are people dropping out of the market? We've seen some of the smaller surveys, private surveys, flagging problems, maybe minor problems, but, these problems have been building up. It obviously also makes a mockery of that headline number coming in there when you see unemployment going up. Now, there's people like your Zero Hedges who are looking at other reports, the Household Labour Survey, which showed I think it was a 600,000 drop in jobs and this and that and the other. You can always pick holes in it. But I think for me, the worrying part is that unemployment rate going up and that participation rate going down. Now, even with those numbers, 4%, we're still at full employment. It's not a collapse in the market. But if the Fed wanted to keep their we're not going to hike stance, that's the sort of thing they'll look at more than the headline rise in jobs. And they already expect wages to moderate further down the line. So we've had the market getting a bit hawkish, as you can expect. Fed swaps see a lower odds of cuts, predictions for September, November, December, and they're actually no longer fully pricing in a rate cut before December. Citi revised their first Fed cut call to September from July. Goldman's are sticking with their 2 cuts that they shifted not so long ago. They see cuts coming in September and December. JP Morgan, they've moved their first cut from July to November and now only see 1 cut this year. These were the mob who saw 6 cuts at the start of 2024 and 3 cuts before they might change this forecast. So they only see 1 cut coming in November, and now they see 4 quarterly cuts next year. Kay, obviously big numbers ahead of the Fed this week. What's your take? Is it good? Is it bad? Are there problems? Is the market looking the wrong way? What's it doing?
Yeah, I want to come back to what I said on Friday, and to a certain extent, I think that's exactly what happened. So the market was going in for finally, is May going to be the day where or the month where BLS finally puts on real numbers and comes in with a very weak one. We have seen those yellowy, orangey flags left, right, and center coming up. Nothing of the like happens on the headline, at least. Whether it's part-time jobs or second, third jobs, the private non-farm payrolls rolled higher. That is, you can compare it a little bit with if you would have only government payrolls in there, right? I think the impact on the dollar would have been less. But that private non-farm payrolls number ticked up as well. And as I said on Friday, there's likely. What would make it worse is that the market went in for a weak number and was short dollars. And there's not that it's nothing worse than that, but we've seen the impact. But it's very hard when the market is forced to buy dollars. And the bond market was looking for a mildly weaker number because we were trading around and even just below 430 on the 10s, for instance. We were trading around 470, 75 on the 2s. And that's the thing. When the market is forced to take the other turn, that's where things sometimes get a little bit painful. And that I think is what happened now. Now we see those private reports on the side, and everybody's screaming and shouting about it. But then us traders, we have to trade what's in front of us, and what's in front of us is a jump of 15 BPs in the 10-year yield. It's a jump of about as much in the shorter end. And if I may directly add something, we've got a pretty dense a bond issuance schedule this week, ahead even of the CPI and FOMC. Only the 30-year is going to be afterwards. So the combination of all of that has sent the dollar higher, and it's a kind of forced dollar buying, in my opinion, and that sometimes is a bit hurting the short term. The short termers, I say if the report would really come out much better, dollar yen could jump straight away to 157. It went to 157 even with a little bit of a higher unemployment rate and the lower participation rate, and we're still turning around 157 despite Bank of Japan doing or scaling back on their bond buying lately. So I think it's a lot has to do here with a case of forced dollar buying, and market being a bit wrong-footed, a bit stunned, because it took a while before really starting to completely roll over. Yeah, that's what happened, and now we're here, and then you put that European election thing on top of things. Euro dollar is getting hammered a little bit, and that's about it. Do we read a lot more? This is one of those where you can, if the bond sharks force Yellen to pay up, as I always say, for her funding needs, start of the week, you can see the dollar go further. I don't know, printed somewhere in the 106s for the euro dollar, even though I think purely on Friday's numbers, I don't think it warrants a 200 or plus point move. But as I said, I mean, if imagine that we're trading above 450 before even CPI comes out in the US 10s, the dollar won't be cheaper, right? Because we've seen the market react to it, and that's where we are right now. I'm a little long dollars via euro dollar. I didn't like the European thing. I've still got a bit my call running on the dollar cat, which is finally in the money. But I'm not like pressing any real buttons to go massively long dollars. Uh, Stuff like cable, for instance. I don't like it to be too short cable, because we see euro sterling as well coming a bit lower. I don't really like to be too long dollar Swiss either, because it's not positive enough to go, because like Swiss needs a positive environment. So so those dollars I'm pretty reluctant, to really start to buy dollars, outright dollars. I really want to see what's happening on the CPI on Wednesday.
Yeah, and we've said it time and time again. Again, using euro dollar as the example. We came through the ECB starting its cut cycle, euro dollar trading up at 109s, and we walked straight into the next piece of data and wallop. Now we're 160 pips lower than that. We get CPI, US CPI on Wednesday, just hours before the FOMC. If it's a weak number, you're going to see this reverse, and all these dollar moves that we've seen now are going to reverse again. You really cannot trust a move from day to day. I've been a bit caught out. I was catching a knife in Kiwi. I don't often go with orders over events like the NFP, but I was being a bit greedy. I didn't want to get a mildly positive number, get a quick spike, and I miss it manually. So I put in some orders. So I'm long Kiwi down to the big figure. It'll be what it will be. I've got my stops planned out. The trade was a loss as soon as I hit the button. That's how I think of things. So it'll be what it'll be. But as I say, we hit CPI, comes in a weak one, it'll reverse. We get a strong one, we'll get further dollar buying. And then who knows what happens with the Fed? Do they turn more hawkish? Do they stick to the same line? It's really hard to have a view longer than the next piece of data.
I think, Brian, that I mean, looking ahead a little bit, if we get a very strong CPI, the FOMC will be absolutely. I mean, I'm not even sure I want to even tune into the FOMC. If we get a weak one, then the FOMC will be extra important. But if we get a strong CPI on top of what we are seeing right now, I think the FOMC is already obsolete before they even do the meeting, because they won't have any other choice but to be hawkish, right? And I think the CPI will really could be a bigger mover than the FOMC this time around, because
Yeah.
they are on pause, right? They want to see something happen. So depending on a weak or a strong CPI, this is actually going, in my opinion, to be a bigger mover than the FOMC this week.
Yeah, but then the market's going to be thinking about hikes again if it's a strong one, and then it faces disappointment again if Powell pushes against hikes and says, "Okay, we're not going to hike, but it's going to be high for longer." That's been our message for the last few months. Does the it's this constant narrative where the Fed says one thing, the market sees data as another thing, and every time we get to an FOMC, it's like, well, come on, Powell. You said this last time, and here we are with a more strong data. What are you going to do? And I don't know how long that can continue before either the market capitulates or the Fed capitulates.
Yeah, if this CPI is, let's say, sticky, okay, without really exploding, because I don't think there's any reason for an explosive number either to the top side. But let's say if it's just sticky, perhaps if he wants to fight back against expected hike or possibilities or risks of a hike, perhaps he can use one of those private reports to hide behind and say like, well, hang on a bit. I mean, not everything is that rosy, so he could use it. He usually doesn't, but since we know he likes to walk on both sides of the aisle, he could potentially use it this time. But yeah, I think it's going to be. Now that we had the jobs report, now that we see the dollar move as well, it's going to be an important one again, that CPI.
Yeah, very much so. But if you want to stay out the election risk, what's going on in Europe, then you might want to leave your dollar long and focus on something else. Right, let's have a quick butchers at what else is coming up this week. Not a lot today. Usually the week after NFP is a pretty quiet one. We do have a few bits and pieces out. UK labour market report tomorrow. We've got the Bank of England coming up next week. So this is going to be a big one for that one. Not so much for what happens with jobs, but wages. You may recall I mentioned at the last jobs report that this month we'll see the numbers coming through from the minimum wage rise that happened at the beginning of April. There was a big jump there. So that may be filtering through to the wage numbers there, which in essence are expected to see wages coming in a bit higher, which obviously puts some pressure on the Bank of England, their thoughts for cutting rates. So that's going to be the big watch tomorrow from those jobs numbers. Get a bit of PPI data out from Japan, and then some inflation data from China as well. Over on to Wednesday, a bit more UK data, GDP, monthly GDP, industrial production. But otherwise, it's pretty quiet until obviously we get the US CPI and then the FOMC later on. In the evening, depending on where you are, we get Aussie jobs as well. So something for the Aussie to keep an eye on. Then Thursday, it's pretty quiet. We get PPI data, which again, coming after the CPI and the FOMC, might add or subtract from whatever the message is there. Bank of Japan, early hours of Friday morning, that'll be dropping there. And then the football starts on Friday. So you can probably forget markets for the next month. European tournament starts off. Everyone will be plugged into that for the rest of the summer. But we do get a little bit Michigan consumer sentiment data out of there, and some price data there, and some Chinese data on the weekend. So not an overly busy week, but there are a few key points there to keep an eye on, depending on what you're trading, what country you're trading, what currency you're trading. Any apart from those auction Ks, anything else popping up that we need to be aware of?
I think you covered most of it, Ryan. FOMC, Bank of Japan, few data here and there, that CPI, and yeah, the UK data are going to be interesting, right? Especially now, and I'd say looking at euro sterling, for instance, which broke under the 85 level, that is going to be one interesting watch then, right, on the UK data. And I think we covered that. And then, there's always something to look out for. I haven't really read up on it straight away this morning because I was busy on other stuff. But there's still a bit of uncertainty to see whether the ANC can form a decent government with the DA in South Africa. The rand is picking up a bit of strength because it seems like some of the more sticky parties have already said that they may not participate or so. So the market is relatively positive right now still. But it may be temporary, I think. And then if it gets confirmed that Scheinbaum and friends have that overall majority, the MEX is still going to be one to keep an eye on. And for the rest, I think you covered everything.
Yep, thank you very much, mate. Right, well, let's have a quick look. Yep, euro sterling. 2 years I've been trading this one, almost, well, over 2 years now, and trading off this level. It's been a good profitable one, but now it's broken. It's broken because of an event more than the fundamentals. So that's a bit of a distinction to make because you want to know how far it might be going after this break. So it's not if this was a move because of rate differentials or big differences between the UK and European economy, then that would be something else. But because it's a bit event driven, I'm not sure what to do with it. I got my stops obviously with a gap lower. My stops got hit a bit lower than they were in at 75. I did pull my reverses on Friday afternoon, and I'm thankful for that. Otherwise, I would have been filled pretty much down near the bottom. So what happens now? Well, technically, we need to see what happens. We're going to get a move down to this low 84 zone, which I would have expected had this been more of a fundamental break, maybe a quick move down there. But with this uncertainty, I'm not sure. Obviously, the break point, 84.80s up to the big figure, is going to be where we see if resistance is coming in. If this election stuff washes out pretty quickly, gets forgotten about, we may get a move back above that 85. But here we have the two goalposts up here at the break point and down here in the low 84s. I'm probably going to let it do its thing in the middle here until something becomes clearer. So for now on this one, I don't know what to do with it, and I'm probably going to leave it alone for a little bit to see what happens. Euro dollar we've looked at, but just to go over some of the levels again, particularly for support. It's down into the low 107s, 107.20s, 25.30. We've had, it's been a prior support point. Under there, we get down to the big 107 area, which has seen plenty of action going back, last year before, and so on. So that's where the move's going to happen. Again, it's just another pendulum swing. If we get a big beat on hot CPI number from the US, we're probably going to be down at 170s if we're not there already, and maybe even more, like cased into the 106s. A lot of banks, as I say, already calling for 105 on this election stuff. I'm always mindful when the market and banks tend to go too extreme because the reality is usually somewhere in the middle. But if the Fed do turn hawkish, then maybe we are heading for a trip to 105s, and I'll keep an eye on that level down there. But plenty of levels in the way of that one. Cables holding up better, although it's having a little wobble under 127 now. So it had its FOMC move, and it's hasn't gone again, but looks like it might be moving a bit in sympathy. Again, the dollar is going to be at the forefront of everything this week with the Fed coming up and that big data. So we're in rally sell mode at the moment, dip buy mode all through the last couple of weeks, and now we're probably in rally selling mode until we get that CPI and the FOMC. A lot of pairs are all looking pretty similar when you're factoring against the Aussie. We had this level 65.80s down in Aussie that's looking a little bit in trouble. It was the prior lows down here. Kiwi as well, similar. It's testing its big figure, got similar sort of level down here at 60, 80, 85. So that's going to be the key area for that one. Dollar yen still waffling around on its own sweet merry world. Obviously a big jump there, but not doing an awful lot more since that move to 157 from last week. So I think Kay, it's probably going to be a bit of hand sitting until we get the data.
Yeah. Oh, this one on the dollar yen in particular. Yeah,
Well, probably dollar altogether.
Yeah, dollar altogether. Yeah, you know, as I said at the top of the show, I got the impression that perhaps the investors or money managers, asset managers, may not particularly like what they saw over the weekend. So there may be some more weakness coming through the first couple of sessions of this week in the euro, and then it's going to be over to the US data, right? Yeah, euro broke. I think we can see low 107s. Why not high 106s? I'm looking at a bit of a triangle since last year. If you want
to take it over, mate.
Yeah.
Yeah, do you want to take it? Let me ping it over. There we go.
Thanks, mate. So there's a bit to do about, and I'm not a big fan at all of moving averages, okay? But I heard people in the market mention it. We're below all of them, all of the daily moving averages. They were all like the last one, the 55 was up at 107.80. We're below. It started at just above 108 with a 100. We're below all of them. And we are also below this little bit of a move that's broken. And again, I'm going to repeat. I think it's more about a forced dollar buying going on in the market right now than really. And of course the euro getting hammered on the back of what's happening over the weekend. So I think it's going to take some reversal of sort to get back above this level. And I'm not going to look at the 107.80, but and I'll show it on the shorter term. The 107.90.10 could be a bit of important here. Nothing else, all else equal, it could be that people really don't like the European story, although I see the crosses are coming off. Yeah, Euro Swiss, Euro Yen, Euro, and even the Euro commodities are coming off now. So there could be a bit more weight on this euro, and I'm thinking about a test of 107, 106.90 perhaps. But if you look at this one, we're still broadly in a triangle actually since July 2023, and we've started to form this one, and I think there's going to have to be really, really strong US data or more crap coming out of Europe to really break below 106.5. I think 106.5, the support zone here, I think that's going to be a biggie, this zone. So call it 106.45 up to 106.70 or so. That's going to be a pretty decent zone before talking about the 106 figure. If 106 figure goes, then I don't know where we can end up right now in the shorter term. So, but this is one that I'm looking at for a bit more the medium term play. So, yeah, we've broken below here. I think we can see a bit of a test of that lower trend line here, So that's 107, 106.90. That's where we could end up. But it all depends what the investors need to do. You know, if they really don't like what they saw over the weekend, there could be a bit more coming. And yes, I think a few things now are looking a bit shaky. So first of all, your dollar makes that you showed already 1850. I'm not going to show that anymore. But then, despite what's going on in the euro mix is getting closer to 20, which is going to be a biggie over there because it's been trading a lot around in the past around this 99.85, 2005. We are trading 1980, right? So this is going to be quite of a zone as well. So imagine for some reason that the euro can stage a bit of a recovery somewhere. This one is one that needs to be closely monitored. Okay. Actually, your dollar makes good bit of slice off, Ryan, because it's turning a tad lower, but this is going to remain very volatile in my opinion.
Yeah.
One other one here is that the rand is trying to look at stuff a little more positive. You see, we've seen those several attempts here, 18, 90, 19 the figure. And this is now starting to be a bit of a level, yeah? We really are going to need confirmation to break back above if the people don't like it, what the coalition will look like to get through up into the 19th. So for the time being, I've got nothing running, but I am still of the overall view that it may all be temporary, you know. I think the market is getting out of perhaps a little bit of speculative positions, long dollars right now, coming off a little. I think we can get back into 60s, even 50s on the dollar rand, but then the party may be over. Precious metals, yes, we are on gold. We are through our 23, 15, 25 zone finally, dragged down by this Friday jobs report. We are stalling, well, we've broken below 2300, which was a bit of a level. Where are we now, right now? 20, we're close to there. You know, I'm not going to stick my neck out too much, but you know, gold is and silver have been quite volatile of late. This, I reckon, still comes on the back of that report that China wouldn't have been buying so much gold anymore in the month of May. But I think it's possible that we are gearing up for a F.A.C.E here. If we start to hold around 22 3/4, I'd love to see a test of this 22.7580. And if that holds and then we start to move up again, we could be building on a F.A.C.E here. Unless, of course, we get sticky, whatever CPI and driving the yields much further, then we can have a move back. And I think Dale is potentially looking for a move back down into the low 22s, but I'm not convinced yet. This thing we have seen in the past. Bit of a shakeout and then starting to move higher again, to be monitored. Bit of a I wouldn't say completely similar because they have been traveling at various speeds, but still a bit similar on silver. We're starting to hold into those low 29s, but I would still want to see, and I need to. Do I need to get? No, I need to get on a tighter frame. Yeah, it looks here. I still want to see what's happening in this zone. If we could get there, I'm probably going to try and reload a little bit more. That is low 20. That's 28, 28 and a half. Okay, 28, 28 and a half. That's where I'm going to closely monitor silver. All right. If in turn we start to get back above 30 and hold, this whole thing may just have been a correction. As you can see, there's a bit of flag stuff going on perhaps there. I don't know. Could be a bit flagging here if it holds already around the low 29s. That for the precious metals that I am following, okay? I'm not following all of them. Yeah, dollar yen into Bank of Japan. This one here, this little bit of a channel-ish going on. I think 155 for a starter, and then see what happens in the 153s, 154s come the Bank of Japan. And of course, it's going to be a US CPI play as well. If that's remains sticky and FOMC needs to be hawkish, I don't know for how long a reduction in JGB buying, depending on the size, of course, but I don't know for how long it can play. I'm not involved right now, and barring like very short-term blips in the yen, just a bit of a a bit of a trade here and there, but for not more than perhaps half an hour or an hour if I see something develop. And with that, Ryan, back over to you for the start of this week. This seems to be enough for me.
Yeah, thank you very much, mate. That'll do for the start of the week, as you say. Get us up and running. We'll see what events tickle our fancy this week. Have a good week, everybody. Thank you for coming to the Flow Show. Thank you, Kay, and we shall catch you all up tomorrow. Have a good one, everyone.